Good evening from Los Angeles, California. My name is Charlie Coker, and I'm the Executive Director of Asia Society Southern California. And thank you for joining us for our program this evening, Venture Capital, Southern California and Asia. We'd first like to thank our partners, dot.LA, for their collaboration in putting this incredibly exciting program together. dot.LA is a new tech news site focused on Los Angeles that launched earlier at the beginning of this year. Their mission is to celebrate and empower the booming LA startup communities, which ultimately is fueling innovation globally. We're joined tonight by Ben Bergman, a senior reporter for Los Angeles. Ben is the newsroom senior reporter covering venture capital. Previously, he was a senior reporter and host at KPCC, a producer at Gimlet Media and NPR, and produced 2 investigative documentaries for KCET. He's been a frequent on-air contributor to NPR and Marketplace, and has written for the New York Times. So without further ado, I'll turn it over to Ben.
Thanks so much, Charlie. And I'm excited for this panel today because we're going to be talking about things that are very much in the news, things like TikTok, trade wars, the coronavirus, and what's happening and how it will affect cross-border investment in the future. Over the next hour, we're going to hear how 3 investors are navigating the current challenges and where they're going to put their money. I'm also excited to have a global audience joining us today from the US as well as Asia, and I look forward to hearing your questions. But without further ado, I want to introduce our 3 distinguished panelists. First of all, we have Yida Gao. He's a partner at Struck Capital, a seed stage venture firm based in LA. Before that, he was a tech investor at New Enterprise Associates, one of the world's largest VC funds. And before that, he was an M&A banker at Morgan Stanley. We're also pleased to be joined by Seamon Chan. He's co-founder and managing partner at Palm Drive Capital in New York. That's a venture capital and growth equity firm that's invested in over 80 startups across 5 continents. He started the firm in 2014, and it now has assets under management in the 9 figures. And finally, we have Eric Manlunas. He's founder and managing partner of Wavemaker Partners, an early stage cross-border VC firm he founded in 2003. It's dual headquartered in LA and Singapore with over 400 million of assets under management. Wavemaker announced last month that it's closed its 3rd and largest fund focused on Southeast Asia with 111 million in dry powder. And since 2012, the firm has invested in over 130 startups. So thank you so much to all of you for joining us this evening. And I want to start with the big news of the day, which in case you've been under a rock, I'll give you a quick update. Here it is. Walmart has now teamed with Microsoft in a joint bid for TikTok. A deal is said to be imminent. There's also a separate bid from Oracle. And yesterday, the very short tenured of TikTok, Kevin Mayer, stepped down. This all comes after President Trump signed executive orders requiring ByteDance to divest TikTok's US operations by November 12th. So my first question to you guys, as people who have looked a lot at investments and tech and the region, is why do you think Walmart is interested in TikTok? And Microsoft certainly has plenty of money to do this deal by themselves. Why would they give TikTok a piece of the action? So Eric, I see you there. Do you want to take a first crack at that? And Eric, you are muted.
All right. So yeah, certainly not an obvious candidate for Walmart, but I imagine they're going to try to integrate a lot of their commerce activities into TikTok, given the amount of traffic that social network generates, and they're big in advertising as well. So I think the combination of commerce and advertising are the 2 elements that they'd like to integrate into that massive audience. But who knows?
Yeah, and jump in, Yida. What do you think? And why is Microsoft willing to share
with Walmart?
Yeah.
I think Walmart has been a very innovative company for what it's worth. They acquired Jet a couple of years ago, Jet.com a couple of years ago, and I was at NEA when that happened. And they want to kind of move away from just being known as a large, brick and mortar retailer and go a lot more digital. They have, certain teams at Walmart working on innovation, innovation labs. And I think just this is another example of Walmart, trying to innovate and be kind of on the forefront of digital. And as Eric mentioned, there's so much, volume of content that can go through TikTok that, it serves more than just their existing business, which is, the brick and mortar, but a lot more, commerce can be done. We've seen a lot of companies do commerce through social media. And I think, Walmart's trying to get a piece of that.
Yeah. What's your take, Seamon? I mean, this is such a strange, if you would have said Walmart would have been on this, I mean, someone said on Twitter, next thing you know, IKEA will be putting in a bid.
I mean, I might agree. Like Walmart's very innovative. Like we were investors in Jet.com, so we were pretty kind of familiar with how Walmart thinks about innovation. Kind of being able to integrate their offline stores and integrate them with the innovation online in terms of e-commerce. And now I guess the COVID-19 pandemic kind of accelerates some of the traditional e-commerce and the need to get traffic from especially the new sources and new communities. So I think and there's definitely a lot of innovation from the Asia side and in terms of TikTok and some of the live streaming e-commerce. We have another company called Pop Shop, actually based in LA. They're able to drive a lot of help help a lot of sellers do live streaming in order to sell their merchandise. So I think there's a big need to do more of that to get online traffic during the pandemic. So I think Walmart is very innovative in trying to consider a TikTok, and that will drive a lot of traffic and help them close the gap with Amazon.
Speaking of Amazon, it's probably similar to Amazon's reasoning when they bought Twitch not too long ago. And I think that's worked out fine for them. And that was close to $1 billion. And to your point, why is Microsoft willing to share? Well, I think it's just the massive scale of it. I think Microsoft's primary purpose for this is to be able to get that volume to put to their cloud business. And so they have, I think it's complementary motivations. One is interested in getting that data and getting that traffic into their cloud business, and the other one's interested in experimenting and putting their commerce business in it. So it should be an interesting thing. What I'm clueless about, the big head scratcher for me is why Oracle is bidding, but Larry Ellison's a smart guy, so I'm not about to second guess him. Plus he can, right?
Yeah, he can, although they don't quite have the war chest of Microsoft. But I mean, do you think that Amazon, should this deal go through, and Dow Jones just reported in the last hour that it is the front runner, that Amazon would actually be worried about this? Is this something that will keep Jeff Bezos up at night if this deal goes through?
I don't think this would keep him up at night. I think Amazon's doing so many different things, so many exciting things. I mean, they've created tremendous value even during the last 5 months of the pandemic. That this is probably not going to move their needle, even if it succeeds for Microsoft. I mean, the revenues for TikTok, rumor has it, is really not that large to begin with yet, and maybe it exponentially grows from here once the commerce piece and advertising pieces have been integrated into it. But I wouldn't worry if I was Bezos.
Yeah, but I mean, you guys do a lot of deals. It's not usually the best circumstance to do a deal when you know you have to be sold in a month by order of the President of the United States. How is this outcome for ByteDance? Do you think that they're going to be lowballed and get a less price than they would have ordinarily? Seamon, what are your thoughts on that?
It's definitely there's a lot of there's definitely some political pressure to kind of do the transaction. That's definitely not unusual for usual kind of M&A exits or carve-outs. I would say I mean I do have a lot of some friends working on this. So I think there's on one hand I think maybe they're not able to fully run the full process. But on the other hand, it's a big opportunity because a lot of the strategics they could like move very quickly. So all the strategics that we just talked about, like they have like very dedicated M&A teams. They move very quickly, and now I think there's enough. And also like some of the VC firms or the PE firms, they're also involved, and they are very familiar with these type of assets. So they like some of these folks, they bought like very similar assets before, so they know how to price these companies, and we have multiple parties at the table who know how to price these assets. I think you could get an interesting price. Maybe not the best one, but I think it will be a fair price because a lot of people do want to get a piece of it in the U.S., both the strategics and the venture capital and private equity firms.
And in terms of the actual argument you hear from the Trump administration, do any of you believe that TikTok does pose a national security threat to the U.S.? Is there anything to that argument?
I don't, but that's, it's a fun app. I'm not, I mean, there's been, I've read so many things about it where, on both sides that some of them are scraping data they're not supposed to, but I don't believe, I think this has something to do with really more political than anything else. I think Trump is trying to appeal to his base that he's the only guy that's standing up to China, but that's just my opinion.
Yeah. I agree with Eric. Yeah, I think it's, I mean, like, I think all these like different tech apps, like they all have like for example, like Facebook, like the U.S. government has the Facebook data, like Putin has the Telegram data, so like China have the TikTok data. So I think that's like, I mean, it's very like normal. But yeah, I think there is like a political, I think in today's climate, I think there's like more of emphasis on the security risks. So I think there'll be more security risks, and sometimes there'll be less if like the relations improve, like U.S.-China relations, there will be less of political risk. So I think this type of thing, political risk fluctuates depending on the political climate. So
yeah,
long-term point of view.
Yeah. I think it's a massive win too for TikTok and ByteDance, right? Being kind of the target of the president here, and it really shows that you can have an app that's created, overseas in China, and be given really strong kind of support here in the U.S. And really change the game, because a lot of the times it's kind of the opposite, right? You have a lot of the U.S.-based applications moving overseas, but this is a really good example of the reverse, which we're seeing more and more of.
That's interesting. That's more hopeful than I would have expected, because my next question was going to be, is this action from the Trump administration, along with some of the other action they've taken against Grindr and WeChat? I mean, have you seen a chilling effect from that, and a reticence of investment and working with the U.S.? Have you guys seen any? Do you think this will have a wider impact beyond TikTok?
Yeah, I think there'll be like bifurcation of investments and tech companies. So there's a lot of like business models that will have like the China version and the non-China version. So a lot of companies that have business in both areas, they will need to separate, like TikTok. And as investors, as like earlier stage investors, I think there's like companies that service the China market, and there's companies that address the non-China market. So there's like ex-China internet companies that are very like interesting to look at, invest in.
What about you, Eric? Have you seen it? Do you expect this TikTok thing to have wider implications, or have you already seen them?
We've not seen them. We don't really do, we do Southeast Asia and the US, so we're a little insulated from the activities that's going on in China. But my prediction is I don't believe this will have a long-term chilling effect. I think once the politics, once this finds a home in the US, if it's a US buyer, which sounds like it's going to be a US buyer with all the bids that are out there, I think this will subside. Americans have very, very, very shallow memories, and this will be forgotten pretty quickly. So I don't think, I mean, the US is a very, very affluent and wealthy market that everybody wants to go in here. So whether it be made in China or made in Europe or India, I think the US will always be an attractive market. I think I think ByteDance just was a product of political times. Election year. Unfortunately, the president has to appeal to a certain base where they need to create some tension to be able to create differentiation between them and the other side. So I think it's just politics as usual. But June, July, August of next year, a year from now, I think all this will be forgotten.
Well, yeah. I mean, speaking of politics, we had the RNC this week. President Trump warned that China will own our country if this guy gets elected, referring to former Vice President Biden. And so I'm curious, with two such divergent platforms, it seems, on China and an election happening soon, how are you dealing with that uncertainty? How does that factor into any decisions you make?
Yeah, and for us, we're investing primarily in the U.S. And a lot of it is, trying to invest in the LA ecosystem. But it definitely, affects us. If there are issues, because we have a fairly wide, LP base. So, if there are, increasing tensions between China and the U.S., it could, affect the LP base that we have. It can go both ways, right? You saw, maybe 4 or 5 years ago in Silicon Valley, a lot of VC funds get set up that were based overseas, and they come on California Avenue and set up shop. And then a couple of years ago, they kind of disappeared, and a lot of it was because of the intensified trade wars. And so you saw fewer and fewer opportunities for overseas funds to invest here, because there were a lot of stipulations against having cap table equity ownership from overseas, specifically Chinese investors. So it could be a boon for investors here who have overseas capital, because it may be a way, one of the few ways for them to get access, right, to the startups here in California as a whole, in the U.S. as well. So we see it as a silver lining, is that it allows us to be stewards of capital to investors overseas that may not be able to invest directly into the startups over here in the U.S.
Seamon, what about you? How do you handle the uncertainty of the election?
Yeah, I guess as investors, like we do have to adapt to some of the uncertainties or to some of the new normal. So I guess for it is like there's a lot of politics with even the LP base. I think there's some certain industries, certain investments that kind of will need to kind of like go through all the LPs. So I think it might be I think there's a lot of opportunity to kind of like work with LPs from different regions. So that's why we have a pretty diversified LP base, like across like US, Asia, Europe, and Middle East. I think there's a lot of opportunity, especially in like Southeast Asia as well. Both with more investors there, and also I think there's a lot of supply chain industries like moving there as well. So I think that's interesting. To work bridge that in like the U.S., like Taiwan, and across in Korea, Japan. I think running for as like fund managers, like we just need to adapt to like the any like new normal, and depends on like who wins the next election.
And I mean, the trade war has presented a lot of challenges, I'll call them, but as investors, you have to look for opportunities. So what opportunities has the trade war brought to you?
I think there's a lot of opportunities like the bifurcation, right? And I mentioned a little bit earlier. To get more specific, I think a lot of the a lot of business models outside of China. I think there's a lot of opportunity to kind of like invest in companies there, startups there, especially ones who are kind of rebuilding the supply chain. Like there's like interesting companies like doing like kind of like AI chips. Like there's like there's like interesting companies like doing like kind of like media or ex-China media, like China social media. So I've been seeing some of that. Yeah, there's also some of the whole ecosystem around like AI chips or manufacturing and some of the tech and software that enables them. So we see a lot of opportunity there. I think LA is a good place. It's a good place for manufacturing. There's aerospace. There's like very strong like media and entertainment industry. So I think there's a lot of opportunities to invest in LA, kind of build that bridge to like Asia, especially Southeast Asia and East Asia, even outside China. But in the long term, I think there's probably ways to work together with China because the political climate changes all the time. But yeah, in the near term, there's a lot of opportunities to kind of like work with to build a supply chain and invest in opportunities ex-China too.
Yeah.
And on the supply chain side, we're seeing I don't know if this statistic is correct, but we're seeing that according to some studies, there's only 63% of U.S. manufacturing is really fully utilized. So there's a lot of excess capacity in the U.S. for manufacturing, and it's not so much the sort of the Cold War II that's happening between the U.S. and China right now, but it's what's really accelerated all that is the pandemic. So a lot of people want to be less reliant on Asian supply chains and be able to onshore a lot of that. And there's a lot of capacity here for manufacturers to be able to take up the slack. So we're looking at a couple of interesting opportunities that are trying to create marketplaces wherein they can fill in the excess capacity. So think of an eBay for manufacturing, for example, right? Digital manufacturing, essentially taking all the manufacturing to the cloud. All that means is you can pick and choose manufacturing facilities in the U.S. without having to go back to the Far East to do that. And I think all the saber rattling that Trump has done has created some need for some of these large product suppliers and manufacturers to really start looking into onshoring a lot to the U.S. So there's a bunch of those. We're making some macro bets in those. We've made 2 investments so far in that space, and hopefully it pays off. But the fact that only 2/3 of manufacturing capacity here is being fully utilized really opens up a lot of opportunities for manufacturing startups to try to take advantage of that.
Yeah, I think this COVID, trade wars is definitely a forcing function of how we should rethink supply chain. Onshoring a lot more manufacturing, but also just there's a lot of government stimulus now, right, into developing a better supply chain, so we're not as dependent on overseas, China, other countries. But also in terms of capital, I'd say the international trade and capital sources have kind of dried up during the pandemic, right? Banks are not issuing a lot of credit. They're closing their doors to really a lot of SMBs and SMEs that are pivotal to supply chain. They probably need the capital the most, and they're the ones that are getting kind of the short end of the stick. So in terms of fintech companies, you're seeing a lot of new companies come out to kind of bridge that gap for SMBs and SMEs, small medium-sized enterprises, to help sustain this international trade in a time where banks aren't lending. You're seeing heavy drops in freight in terms of capacity. So there's a lot of strain on the kind of backbone of what drives the global economy from a supply chain perspective. And you're seeing some startups rise up to kind of support that gap.
So I want to ask you what sort of overseas, what specific countries you're excited about and sectors. And Eric, I'll start with you because I believe you guys are focused on 10 different countries, which are all very different. So within that, which is a huge region, what are you most excited about right now?
Yeah, so the ASEAN region in Southeast Asia is composed of 10 different countries, but really the population centers are only about a handful of them. So Indonesia, the Philippines, Vietnam are the main population centers. And of course, Singapore being the center of Southeast Asia, given the stability of legal systems in there, and it's become a global financial hub. That's where we're located, and we're still seeing about more than half to 2/3 of our investments happening in that small country. That said, we're looking at unique emerging market problems that local entrepreneurs are trying to solve for. There's a lot of opportunities in inventory procurement, for example, that's mostly in Vietnam, the Philippines, and Indonesia. Some aquaculture solutions that we're looking at. So it's pretty exciting stuff, because these are the kind of solutions that we're not seeing in the US, primarily because these emerging market problems are unique to that particular region, which what makes our jobs really interesting. So we're trying to focus on large population sets, just like any other investor. They're looking for the size of the market. And unfortunately for Southeast Asia, it's not homogenous. It's a very different, 10 different countries, 10 different cultures, currencies, histories, etc. So you kind of have to figure out how to localize every single solution that you enter into. What works for Indonesia may not necessarily work for the Philippines, for example, even though the socioeconomic demographics are the same. So so when we started Southeast Asia 8 years ago, we identified 5 major trends that we thought were force multipliers that would create the nice tailwinds for investing. And a lot of those trends have materialized over the last 8 years and continue to materialize. Primarily, those are, number one was the rising socioeconomic class. Wealth is being created every single day, and that's not going to stop for the next 10, 20 years. So there's nothing but upside there. And if you've spent some time in the region, you'll notice that there's a huge housing backlog and a huge infrastructure backlog. Again, not too obvious for startups, but those 2 things create large economic multipliers that are great for tailwinds for startups and entrepreneurs to solve for. And fourth and fifth reason are the fiscal conditions of the countries are much better compared to the West. If you look at the European countries and in the US, after this pandemic, we'll be at about 130% debt GDP, which is the highest it's ever been, higher than World War II, in fact. And we're not seeing any of that. There's a lot of debt capacity in that region. So in our view, there's nothing but upside. And of course, last but not the least, the demographic dividends. It's a very young population, very digital, and very sophisticated when it comes to mobile applications. So that's why we went to that region. And, again, a lot of people, a lot of wealth being created, and a lot of internet sophistication happening.
And it is part of the appeal also. It's just lower valuations. You guys are all outside of Silicon Valley and focused outside of that.
Not necessarily anymore. There's been a lot of there's been a lot of inflation for the last 3-4 years. It's become a little tricky to. That was certainly the case in circa 2012 to 2014, 2015. But more funds have come in, more capital has come in. So a lot of capital is chasing fewer deals, as the cliche goes. So there's been a lot of valuation inflation. But for the most part, it's still a little bit more, they're a little bit more reasonable than the Valley. But I'd say it's at par from a valuation perspective. Singapore and LA are practically at par right now. Sometimes Singapore more expensive, to be honest.
But not at par with Silicon Valley.
No, nothing's at par with Silicon Valley, right? I mean, those guys are not. Silicon Valley is not valuation sensitive, so nothing will ever be at par with Silicon Valley.
Yeah, it's tough to be on par with Silicon Valley, which is where I spend a lot of years. And it's simple supply and demand, right? You have so many funds in Silicon Valley. For each fund in LA, there's probably 25, 30 funds in Silicon Valley. So they're just chasing, the same amount of, good deals. So the price gets bid up. So I think, that's one of the reasons why, we like LA, is that, there aren't nearly as many funds down here. There's great kind of ecosystem. There's more engineers in LA than in the Bay Area. It's better living conditions, better lifestyle. And Silicon Valley is just a plane ride, I guess, and now a drive away. So, we're a seed fund primarily investing in early stage companies, before they raise their Series A. And when that happens, it's very easy for us to introduce them to a lot of the large Series A funds in Silicon Valley. But I think, overseas wise too, the valuations won't be as as crazy, but as Eric mentioned, right, everything is rising. There's a lot of inflation going on, and one area that we also invest in is in the and Wavemaker does as well, in crypto and blockchain. And I'd say I was thinking, what are the types of companies that we invest in that are overseas? And a lot of it is in the cryptocurrency or blockchain ecosystem because of how global it is, and we need to. So I think that's an area where we kind of see opportunity outside of the U.S. ecosystem.
Yeah, I would say that's the whole thesis of our fund. Like, yeah, I mean, I guess my partners went to Stanford, so we are active. We do look at a lot of companies in the Bay Area, but sometimes the valuations make no sense. So yeah, so that's why we like to invest in find companies and invest in companies in places where people aren't looking as much. So that includes like LA, and that includes like New York and even the rest of the US. I think there's lots of opportunities. There's very good talent, like very good entrepreneurs. Lots of like these states have like unicorn companies. And then kind of extending that to like some other parts of the world as well. I mean, a majority of our investments are in the U.S., but I think there's a lot of opportunities to even bring some of the U.S. Companies to other parts of the world. So like we bought a company called Clover Health. We brought them to Asia, and we got them a part of a strategic called Cathay Life. And Cathay Life ended up investing in the company and doing a very good like partnership. So we see a lot of the kind of like the US, like Asia partnerships, a lot of opportunities for that. And of course, like there's opportunities to invest like Asia, we definitely like I mean, China, the valuations are very high and we haven't done a lot of China, but like Southeast Asia and like Taiwan and some of these areas, like very good like kind of engineers and maybe more reasonable valuations. I know it's getting high now, especially in Southeast Asia, but more reasonable. And there's like some companies in like Taiwan, like Hong Kong that are looking to get into these regions. They used to go to China a lot, but now a lot of them are trying to go into Southeast Asia. So we definitely see some opportunities there. Like we have a company called WeLab in Hong Kong. They're entering Indonesia with a partnership with the Astra Group. So yeah, so we see a lot more of these trends to connect the U.S. and Asia, and to connect Southeast Asia to East Asia.
Yeah, and I mean, Seamon, you said one time that firms in New York and startups there were more valuation sensitive because there's more banking and finance in New York, and people are used to using more conventional metrics versus Silicon Valley, which is not.
Yeah, exactly. Yeah. I mean, the the folks in New York, right? They're looking at more conventional metrics, like looking at more public comparables, and kind of like having like basically like kind of like finding valuations that will help everybody make money. So I think it's a little more realistic, and the valuations are a little more grounded in New York, in my opinion. But it's still high. It's still high compared to some other areas. Still, but definitely not as high as like the Bay Area.
So Seamon, what just going back to my previous question before the valuation tangent, what regions or what countries, sectors that are under the radar are you most excited about right now?
Yeah. I guess I mean I've been spending a lot of time in Taiwan recently, so I think there's very good engineers, very good the last generation of like very successful hardware companies like TSMC, MediaTek, a lot of spin-outs, and there's a lot of chances to. I mean, Taiwan's a smaller market, but it's like big enough to get some initial traction, and then there's a lot of markets around like the Japan. A lot of companies go to Japan. A lot of companies go to Southeast Asia. And then like eventually, hopefully, so some of them could go to the U.S. as well, because they've done, especially a lot of the hardware or AI chip companies, and now increasingly like more like software or new media companies as well. So we definitely see a lot of talent, and also a lot of people are stuck in Taiwan recently. So because Taiwan has done managed the COVID pretty well, so a lot of people have moved back. A lot of the Silicon Valley entrepreneurs, like a lot of investors, like have moved to Taiwan. So I think that'll help the ecosystem here a lot. So yeah, so I think it's kind of like a little underserved by VCs here, not too many VCs. So I think there's a lot of opportunities to invest in startups here and help them expand outside of Taiwan.
Yeah, I mean, I think with the pandemic, right, everybody is now comfortable working from home. Nobody, nobody needs to be really in the major cities anymore. New York City, San Francisco, capacity, in terms of rental properties has increased a lot just because a lot of people are moving out of the Bay Area because of the pandemic. You don't need to be 400 square feet apartments anymore. So I think going forward, right, we're going to be pretty surprised about where we see exciting companies and startups to invest in will pop up. You can be in Taiwan and run a distributed team that has members over here in the U.S. So it makes the investor's job a little bit harder, right? When you need to kind of uncover rocks across the world. But I think we'll be pretty surprised on where the next kind of billion-dollar unicorn will come from.
And what's it been like operating during this time? I don't know how much you spent on the road before, but obviously you haven't been able to do that. Eric, you actually closed a fund and it was oversubscribed during coronavirus, which is impressive. But how has it been, closing deals and closing a fund on Zoom?
Well, we're structured a little differently. So we have a team in Southeast Asia. We have a team of 18 folks down there, primarily mostly in Singapore, but we have an analyst in Indonesia, Vietnam, the Philippines. So we do have presence on the ground. They're all also locked in, but at least they're on the ground. Pre-COVID, I would be visiting with my team every other month on average. In fact, when the pandemic was declared, this was not Southeast Asia, but my wife and I were in India. And so we got back here just before they closed the borders. But so no travel since. So it was a little challenging from the very beginning, but I think I've gotten used to the routine. In fact, I was just bragging to somebody that all the hundreds of hours that I've saved from driving, and I'm not even talking about the flying hours. I'm just talking about just driving from my house to our office in Santa Monica. So it's worked out pretty well. One of my associates actually went back to Spain, where he's from, and he's maintaining U.S. hours from there. So I think we've from the VC standpoint, it really hasn't been that challenging. It shouldn't have been that challenging to begin with. Overall, we've done a lot of follow-on fundings since March on both sides, and we've made a few investments on the U.S. and Southeast Asia side as well. So it helps to have two teams on each side. If we were all located in the U.S., that probably would have been a lot more challenging. But the fact that we are located in both sides of our practice, and we run them autonomously anyway, we run them separately. So it's helped us out from that perspective. So no complaints here. In fact, it's been nice not to jump on another 17-hour flight. That's probably going to resume Q1, Q2 of next year, but I'm not missing it.
Do you think it will resume? Do you think that there will be less travel needed in the future because we're so used to doing this now?
Yeah, there's less travel needed, but it's not going to be. It's not going to. I go there not because I'm required to go there. I go there because to have FaceTime with our team. You got to maintain culture. Talk to my partners down there. And by the way, he was really responsible for a lot of the heavy lifting on the last round that we raised. And we closed it during pandemic, but we started that thing pre-COVID. So it wasn't all done during the pandemic months. So we feel very fortunate that we were able to close it. So I go primarily for FaceTime, and there's a lot of things you cannot capture on Zoom. There's a lot of serendipitous meetings. There's a lot of random meetings you meet with entrepreneurs that cannot happen in Zoom. Zoom's very deliberate. You go on Zoom because it's scheduled, right? You don't go to Zoom because you're hunting for new entrepreneurs to meet. So those are the things that will never be replaced by video conferencing. And so I go because we want to continue building a business down there, but it's not because it's required. But there's no doubt in my mind that business travel will continue to be depressed for probably another 18 months from here. So you may not see the old levels until 2022, or until a credible therapeutic is developed, or the medical breakthrough, which is the vaccine.
I just want to tell our audience we're going to go to audience questions in just a few minutes. So if you have questions for our panel, please type them in, and we will get to as many as we can. Yida, how has your approach been? And I guess another question is, if I were to have told you in March that, from all indications, it seems like valuations have remained pretty lofty and deal volume has been pretty good, would you have believed me after we've been through a 100-year pandemic and the worst, global recession in a long time.
Yeah, no, I think, it has been pretty tough for, some portfolio companies of ours, right? Kind of managing through the pandemic. The government has been helpful with PPP and some of the other stimulus packages and we try to help our portfolio companies kind of get those stimulus dollars before they ran out. I think in terms of going forward, right? If you are, a strong founder with a strong idea, and you have the capital to kind of sustain, have the runway to sustain through this type of phase where there's less revenues, net less kind of usership, depending on what type of startup you have, then you'll come out of it pretty strong. And I also think that a lot of VCs have dry powder right now, right? Large funds getting raised, they're itching to invest, and there's definitely an opportunity cost to just have that dry powder in cash. So we were pretty thankful of the fact that our portfolio companies have, most of them have the runway to sustain this, this COVID situation, and they'll come out of it being able to raise subsequent rounds of financing because there are a lot of VCs still out there that have raised their largest funds in history, beginning of this year and last year, and funds have 3 to 5 year cycles, which means that there's still plenty of dry powder for the next several years. I think that valuations, are going to be a little bit subdued. VCs are using this as an opportunity to, cut the valuations. We've had, instances where, term sheets were issued at a certain valuation, and then, a month later after, the pandemic happened, there's a retrade and the valuation went down, let's say, 20%. So that is happening. But I think at the end of the day, again, look at supply, demand, there's a lot of, capital out there. And if you are, a strong founder, with a great idea, I think you'll still be, in a good spot.
You guys are ruthless. What about you, Seamon? What are you seeing vis-a-vis COVID? And also, are you surprised that how resilient most markets have been?
Yeah, because I did expect, because there's less traveling, so I did expect maybe to have less activity. So definitely surprised that it has been pretty resilient. I think some of the online business models have done very well during COVID, including most of them in our portfolio. So I think that has been driving some of the the VC activity and the valuations. A lot of our companies have grown, like the food delivery, like self-driving cars, like cybersecurity, like telehealth, like online fintech, enterprise software. So a lot of these companies, they need to work more remotely. So we have been seeing a lot of activity and from some of these companies. And that's why some of the valuations are still very, very high. That's why we try very hard to find companies companies in places where people aren't looking. I think that's the only way to kind of have more reasonable valuations. For example, we have a company called Catalyte. It's in Baltimore. So what it does is it trains people to become software engineers, ordinary people. So people working at Starbucks, McDonald's, kind of train them to give minimum wage to upper middle class in terms of salary. So that company has done very well because a lot of the clients are Fortune 500 companies, and they've been trying to work remotely, find remote engineering teams. So they're trying to build. The company's in Baltimore, so there's not a lot of startups. There's not a lot of VCs there. So I think it's a very good opportunity to invest. And kind of help them expand to other areas in the U.S. Even help some of our portfolio companies build remote engineering teams and even take the model to some overseas markets. So I think that's a good way to invest at reasonable valuations and help these companies expand, like to even bring investors in Silicon Valley and beyond.
We have time for just a couple questions. Good question from Chris Bailey. He says a question on cross-border teams compared with ventures that are based in one location country. What do people look for in a team that is based in multiple countries? What advantages are you looking for, which outweighs the disadvantages of that structure? Eric, do you want to take that as someone who's done this for 20 years?
Sure. Yeah, that's a big topic, but let me say this. So most of our experiences with our portfolio companies are, well, a lot of them have had distributed teams. It hasn't been the dominant model for them. And just because we run a cross-border practice, it doesn't mean that each portfolio company of ours are both located in the US and Southeast Asia. As I mentioned earlier, we run them autonomously, and we have exclusive funds for each geographies that we're focusing in. But the ones that we've experienced, time zone obviously is a very big factor. You've got the US-India time zone that's manageable, more manageable from the East Coast than the West Coast. Fortunately, most of the there's no language barriers. Most of the engineers that in our experience, most of the portfolio companies, if they had engineers in Belarus, for example, or they had engineers in India or the Philippines, English is the medium of the language that they're all speaking. So there hasn't been any challenges there. But whenever it's time to really bring in the main engineers, they become employees, and they typically sit on where the headquarters are of these companies. So we're not. I guess most of the factors that we're looking into is, and when we're advising our companies, is just make sure that they do have familiarity with the way U.S. companies run at the pace at which it runs, because that's a big factor. Cultures are different, and sometimes engineers overseas are not as fast paced as the one in the U.S. So they're looking against those, guarding against those. Time zone is a big consideration, and of course, just relevant domain knowledge and experience is always helpful when it comes to looking for these engineers that are developing the technical aspects of your product.
Question for Yida from Marilyn Marchetti. She says, do you ever think we're going to go back to the pre-COVID days, given the fact that another pandemic could be right around the corner? Will we always be worried about the future?
That's a great question. If you look at other countries, right, in terms of wearing masks and being very safe when it comes to hygiene, that already happened, pre-COVID. So I don't think it's going to be too different in terms of just making sure that everybody stays safe in a post COVID world. I don't think it will be a lot of things will be different. Fewer people are probably going to be going to movies, and your lifestyle may be a little bit different, maybe for the better. But I think in general we'll come out of this a little bit stronger. And there's definitely, we don't focus too much on healthcare, but tangentially we will. There's been a lot of demand and capital flows into startups that are in the healthcare space, be it from telemedicine to biopharma to others. So I think the world shifts, right? When there's a pandemic, we'll shift to focusing more time on how to prevent the next one. So I think as investors, we just have to understand how that shift will happen, and where to place our bets. And I think there's always going to be opportunity when you have these types of big pandemics or health scares. So yeah, I think it'll be different, but it doesn't mean that we'll be worse off than before the pandemic.
Well, plus the next pandemic is not supposed to be due until 2119, right?
2119, yeah.
We'll all be gone by then. So.
Yeah. Well, there's a lot of how this virus kind of came up, right? Was because of the intermingling of different species, and given what's going on with global warming and the fact that there's massive rampant deforestation, animals are just getting closer and closer together. And so maybe it won't be, we may be alive for the next one, given the rate that, our forests are getting, kind of demolished. So I think the counter to that is, more government spending, more VC spending, more capital, flowing to ways to come up with, more powerful vaccines that can handle these types of, scares and health crises.
Well, hopefully we can end on a slightly more upbeat note than that. So I'm just going to quickly ask you to go around with one last question very briefly. Do you expect more deals to happen in the next 3 months, the remainder of the year, than happened in the previous 3 months? Eric, are you going to make more deals or less deals?
Probably less deals compared to the pace we had from last year, but practically the same from what we've seen the last 4 or 5 months. We're throttling back. We're really calibrating it a little slower. We just want to get a much better sense of who's going to need more help within our portfolio, and want to make sure that we have the dry powder ready for those just in case they need it. We're not, supposedly you're supposed to see valuations crashing, right? We haven't really seen a lot of that yet. I've heard some anecdotal stories that valuations are much lower than from February. Unfortunately, we really haven't seen much of that. So there hasn't been that many compelling reasons why we should speed up our pace in which we deploy capital. But really, more importantly, we just want to make sure that we have a pretty good sense of who's going to need help in the next 18 months. We don't think it's going to be a V-shaped recovery. We believe it's probably going to go through end of 2021. So we just want to make sure that we have the capacity to be helpful if we need be.
Seamon, what about you briefly? More deals or fewer deals than?
I think maybe more deals. Yeah, I guess. Yeah, I think there's a lot of opportunities. I mean, we have a new fund. Like we have like a lot of dry powder as well. So and I think there's still a lot of opportunities. Like these online business models doing really, really well, like growing 20-30% a month, or we have some companies growing 60% a month. So first of all, we're going to make sure that our portfolio companies will get support, especially that sometimes they can't travel or try to raise follow-on rounds. So we'll spend a good portion of our capital to support them. And second is we just think there's a lot of new opportunities as well. Especially we could look at we look at in places where VCs aren't looking as much. So the rest of the US, globally, we do see a lot of companies. For example, we just invested in a super app in Northern Africa. So that company does ride hailing, food delivery, payments, it's called Yasira. So companies like that are doing very, very well in the pandemic, and we look forward to doing investing in more of these companies in the US and also globally.
Yida, you get the last word.
Yeah, so I'll keep it short. So I think pace will be kind of similar to us. We have a steady number of deals we want to do per quarter, and we don't want to kind of get off of that too much just for portfolio construction. But I'd say a lot of we cut down on the number of companies, startups that pitch us, right? Crazy ideas that could have worked pre-pandemic probably aren't going to work now. There's more of a focus on profitability, given that runways need to be extended. So I think we'll continue to invest at a steady clip, but the kind of bar to investment has increased, and we're definitely the same amount of diligence, if not more, when we do new deals and diligence new companies, because we can't be in front of them and on the other side of the table as them. So most of the time now. So we have to do a lot more diligence over Zoom, over email. So we're seeing more of that going forward. And I think in terms of opportunities, we'll still see more of, and probably more outside of our regular ecosystems of LA, Bay Area a little bit, and the East Coast. So we're a little bit more broad now, I'd say, as well.
All right, well, thank you so much to the three of our wonderful panelists. Also want to thank our friends at the Asia Society. Hopefully we can do more of these great events, and I'll turn it back over to Charlie.
Ben, thanks so much to you and Yida and Seamon and Eric for an amazing discussion about the venture capital space. Likewise, we very much look forward to working with dot.LA on future programs. We'd also like to thank our promotional partners, American Chamber of Commerce Shanghai, the Asian Business League of Southern California, the Hong Kong Association of Southern California, and the USC Marshall School of Business IBER MBA program. We also like to let people know that our next program will be for Asia Society Southern California will be on September 2nd at 5 p.m. The program will be Standing Against Racism in the Time of COVID, Part 2. This is a follow-up to a program we had on May 3rd, and we'll be featuring an amazing cast of panelists, and hope you'll be able to tune in. We also like to ask folks, if they haven't already, to consider being a member or donating so that we can continue to make these programs available for free to the public, so that we can continue generating, getting information out at the highest level to the audiences. And you can either join at www.asiasociety.org/memberLA, or you can make a donation at www.asiasociety.org/memberALA. Sorry. So one is the member and one is for the donation. So thank you again, and we look forward to the next time. And thank you, everybody.